Now what we want to do is look at the last component in this equation, way back over here, RS, right? So the cost of common equity. This one is the most complex of the three, and there's several reasons for that. One reason is there are multiple sources of common equity, right? The first source that any firm is going to want to use first is going to be reinvesting their existing profit. That money belongs to shareholders, and while it may look like free money to a firm, like it should be zero cost, it's the shareholders' money. And shareholders could use this, there's an opportunity cost, they could use it for other investments. And so a firm needs to have an idea what kind of rate of return investors require on their equity investment, what's the opportunity cost of this stuff. So internally generated equity is reinvested profit. What the book calls retained earnings, that's reinvested profit. It's got this implicit cost, right? The required return that investors demand on their stock investment. If firms are growing particularly fast, they may not be generating enough profit. In fact, they may not be generating any profit if they're a young growth firm. That might be negative. So where would you get equity? You might have to issue additional shares of stock, right? So issuing new common stock is an alternative form of acquiring equity for growth. This one has both the opportunity cost and it has explicit cost, like flotation costs we talked about with bonds. Right, so one complexity about equity is there are two different sources of it, internal and external, right? Reinvested profit and retained earnings. The other complexity is this. If we go back and look at a bond, when bonds are issued, or heck, even a loan contract with a bank, you know almost all the relevant parameters or terms on the loan or the bond. You know how much interest you're going to get, exactly when you're going to get it. You know everything. The only thing you're not certain of is will there be a default, right? Will the borrower not make all their payments on time? So there's credit risk on a bond or on a loan, right? That's about the only thing that you have to worry about. Preferred stock, same basic thing. I know how much the dividend is. I know what the current price of the stock is. My only worry with preferred stock is, will the company continue to pay the dividends, right? They won't go into bankruptcy if they don't, but they could miss dividend payments. That would affect my return. But with common stock, there's a lot more uncertainty. For example, with common stock, you don't know how much dividends you're going to get. Why? Because dividends can vary the profitability of a firm. If a firm is a young growth firm, it's probably not paying dividends. If they're a mature firm, they probably are, but the dividends may go up or down, say, with the economy, right? If the economy starts, back in 2020, when everything got shut down, lots of companies suspended their dividends in that year, and they didn't start them back up until a couple of years later. So in other words, unlike a loan contract or a bond, where things are contractually written down, there's no contract that says a company has to pay a dividend, or once they pay one, they have to maintain it. They could stop it at any time. The dividend can change over time. That means there's a lot more uncertainty about what kind of cash, the growth rate too. How fast is the company growing? How fast is their stock price going to grow? Those are all uncertainties. So when you have more uncertainties, what ends up happening is we find that there may not be a single way that works best for getting the cost of equity. There might be multiple ways. And these are three of the more common methods of getting the cost of common equity. So capital asset pricing model, CAPM, your discounted dividend model, right? So what I call discounted cash flow or DCF approach. And then something, you probably had this back in the 33 finance course, but bond yield plus risk premium. Basically takes the company's bond yield and adds an extra amount of return because stock's riskier, it gets paid less, so it should have a higher return than a company's own bonds. So we're going to go through computing each of these, and then we'll go back and start looking at some of the issues with getting the cost of equity. So let's look at capped-in first. So I've only got three inputs, right? I've got a risk-free rate, I've got a market risk premium, and I've got the beta. The only thing specific to the firm is the beta. Everything else is market determined or macro. So, you see here, we've got a required return of 15.8%. In a bit, we'll sit back and talk about each of these three inputs right here. Let's look at a couple of problems that do exactly this. I'm not going to linger on too long, but I just want to show you some differences in the lingo of the problem so you're aware of it. So let's see, let's look at 10.6 first. Right, so we've got a company, we're using CAPM to get the cost of equity. We've got our beta, 0.8. We've got a market risk premium of 5.5%. And they're giving, they're saying the return on the average stock last year was 15%. They've given us a 3-month T-bill rate and a 10-year Treasury bond rate. Right, so we've got a couple of things here. Treasuries are our risk-free rate, right? So let's put the equation up here. All right, so beta's clear enough. It's going to be 0.8. They're telling me that the risk premium in the market is 5.5%. That the market had a return, or it said the return on the average stock in the market. The return on the market last year was 15%. That's irrelevant. That was last year. Remember, we're trying to be forward-looking on this stuff, right? So I don't need what last year's return was. What I need is the market risk premium. Now, what am I use for my risk-free rate? Treasury bond? Yeah, so here, I'll be honest with you, and we'll talk about this in more depth in a little bit. There are analysts that use the 3-month T-bill. There are others that would use the 10-year Treasury bond. We'll discuss in here why it might be a better choice to use the longer-term 10-year Treasury than the shorter-term 3-month T-bill. We'll wait till we get to the specific material about that. But I would be using the 10-year Treasury bond, so the 6%. Now, and also remember that the market risk premium is in fact the market return less the risk-free rate. Right, so when you hear market risk premium, it means how much the market is expected to earn above the riskless investment, right? Premium above the risk-free rate. Keep that in mind, so we'll look at another problem that gives us some different, or the inputs look different, okay? So the average stock would have earned 5.5% plus 6. So not this company, but the average investment, something as risky as the market itself, would have earned 11.5%. In fact, that's the market return right there, 11.5. Risk-free rate plus market risk premium, okay? Our stock isn't as risky as the market, so it shouldn't earn as high a premium because it's not as risky. It's 80% as risky as the market, so it should earn 80% of the market risk premium. And that's a premium above the risk-free rate, so then we attach the risk-free rate to that, okay? So that's kind of the explanation of what we're doing there. Let's look at another problem real quick. We're not going to compute this one. But let's look down here at 1110, Part B. We're using CAPM again. Here's our beta, 1.6. They're nicer in this one. They just told us a risk-free rate instead of having us go and pick between treasuries, but 9% for risk-free rate. But now look what they say here. Return on the market, 13%. Right? They didn't give me a market risk premium, they gave me the market return. So here I know that market return is 13%. I know my risk-free rate is 9. So that tells me that the risk premium is the 4% difference. When you have a problem with CAPM, be very careful of, are you given the market risk premium or are you given the market return? Right, so have to be aware of that. And that's what I wanted to show you there. All right, let's go back to the slide real quick. Okay, so that's simple enough to compute that right there. The complexity is what risk-free rate do we use? We'll talk about that more in a bit. And being aware, are you given the risk premium or are you given the market return instead? Let's look at the DCF method. Again, working through the math is simple enough. It's just the dividend over the stock price plus the growth rate. Don't worry about these bullet points in blue down here yet. We'll hit that in a bit. All right, so we've got an expected dividend, D1, 234. Stock price sells at 46.75, and we have a growth rate of 12%, so we get 17 overall. Let me rewrite this equation. It really looks like this. So here's what I have up there. It's the same as this. See what I've done that's different is the dividend part, right? So the expected dividend at the end of the year is the current dividend increased by 1 year's worth of growth, right? So keep that in mind. Current dividend, most recent dividend, right? Something that says current or past tense, right? The last dividend paid, D0. The expected dividend, the next dividend. So let's look at a couple of problems to illustrate what you have to watch out for if you're using this method. All right, let's go back up here and let's look at 11.5, dividend growth model. I'm not going to work, I'm not going to put everything together, but they're telling me it's D1. They're being kind, but they didn't have to do that. How do I know this is D1? Stock is expected to pay, right, a future dividend. That tells me that that is D1. I don't want to increase it by any more growth. It's already bumped up 4 years worth of growth, okay? Let's go down here to 1110. Look at the original narrative. Stock sales were 23. The last dividend was $2. D0, right? So that is a D0 growing at 7% a year. So if I were putting this problem together, it's telling me $2 increased at 7%. That's the numerator. That's 214. And you notice they also tell me the company will, or you could say expected to pay 214 into the current year. So D1, right? So you see how they got those two numbers and why they're different. They're different by 1 year's worth of growth. That's about the only thing to really watch out for with that DCF formula, is that. Again, we'll come back to the blue bullet points a bit later. Let's look at the last of those three methods, this bond yield plus risk premium method. So this one I have to be careful of. The bond yield that we're putting in here is not a treasury bond yield, it's the company's the cost of the company's own debt. So you notice what I have here? I've got R sub D. That's the cost of our debt that we're getting. That's the pre-tax cost of debt. So, you know, treasury rates may be 6%, but we're riskier than the treasury, so we have to pay a higher rate to people who buy our bonds. Maybe our bond rate is 8%, right? So that's what we put in there. So that number is going to vary by companies. Companies that have high default risk will have a high RD, and companies that are fairly creditworthy will have a lower RD. Still above the treasury rate though. The risk premium is something else to be aware of. This is not the market risk premium that you get in CAPM. This is how much the company stock tends to earn a return above the company's own bonds. So very different, right? This is how much the market tends to return above the risk-free treasury. This is how much the company's stock earns return above the company's own bond rate. Okay, so you see the difference in those two. So here, this is saying that the company currently has bonds outstanding that have a cost pre-tax of 9.64%, and this company stock tends to, or investors tend to require 7% higher return than what they require on the company's bonds. So we get 16.64% on this. Let's go back and look at these three slides real quick and let's get some numbers. Here's CAPM. We had 15.8. And then we did discounted cash flow. We got 17. And then we did this bond yield method. And we got 16.6%. Lots of analysts will use one of those methods, that's it. But quite a few analysts, if they have the data, will use multiple approaches. Why? Because there's a lot more uncertainty with equity than there is with debt or preferred stock. So you're not really certain what the number is. We'll see how this uncertainty kind of creeps in a bit. So I may not be really certain about this number. We'll see why there's uncertainty in this number. And there's even more, and there's uncertainty here and here. Each of these numbers has a lot of uncertainty in it. So what's a way to deal with that? If I'm not particularly confident in any of these numbers individually, I might average them and take the average instead. Right, so I could take the average of this, whatever that comes out to be. What is that, by the way? So 15.8. So I'm going to get 16.5%. I might use that average as my actual cost of equity. So when analysts do multiple methods, a common thing is use multiple methods, take the average of those methods, that's your cost of equity. What if they just do one method? Then just use that number, right, instead. So there are a number of ways to do this. Now, let's go back up here real quick, back to this different sources of common equity slide. So remember, we got internal generated and we've got external. And one of the cost of external equity is this flotation cost that's charged by the investment bank. You don't have to pay that with reinvested profit because you already have it. But to issue new stock, you're going to have to get that financial institution, to help you, and they're going to charge a fee. So we have to have a way of incorporating that fee, and that fee is often going to be based on the stock price. The only method here of these three that has a stock price in it is the DCF method. So we're going to use that method exclusively to get the cost of new stock, because that allows me to adjust the price for flotation cost. So let's see. Here's our cost of equity again. Here's the original problem that we did. Expected dividend 234, expected to grow at 12% a year. Stock price is $46.75 in the market, so we got 17%. That was that number there. But now it's saying if they issue new stock, they'll pay 13.28% flotation cost on each share. So that means that gets taken away by the investment bank, and the remaining, 87%, 86.72% that remains, that goes to the firm. So put differently, people who buy the stock, the investors will pay $46.75. And out of that $46.75, 13.28% of it will go to Goldman Sachs for helping to issue the stuff. And the remaining 87% roughly goes to the firm whose stock's being issued and sold, right? Because the firm's getting less money, but they have to generate the same 17% return to investors, they've actually got to earn a higher return because they have less money to do it with. So you see what's happening here, because this is going to give us a lower price net of float, it increases the cost of new stock. It's still, investors still look at it and think they're earning a 17% return, but if I'm going to issue new stock to you guys, for you to get 17% return, I've got to generate 17.7% return on it, because I have less money than what you've paid to buy that stock. Right? So that's the basic idea there. And the difference in these two is what's referred to as a float adjustment. That's how much more expensive new stock is, or external equity, than internal equity. Now, how could we use that float adjustment? Well, this could be my internal equity right here, 16.5%, right? The average of those methods. And so I did this right here to find out my float adjustment. 0.7%. So now I get 17.2%. That is for my cost of new stock. So I can still do an average. I'm going to use the DCF method to find out how much more expensive new stock is versus reinvested profit. And I'm going to take that difference, that extra cost, and add it to my average. That's going to give me my cost of new stock. All right. Let's look at a couple of problems at the end of the chapter that do exactly this. So let's see. Okay, we already did 11.6 right here, and let me erase some of this mess. It looks like that's going to be 10.4. Wait, that's not the one that I want to see. Pardon me. Okay, sorry, that's not the problem I want to look at. Let's look over here on the next page. Okay, so 11.13. So let's take this data right here, and let's first get reinvested profit. All right, cost of reinvested profit. We're going to use exactly that data from 11.13 to do this. So let's see, and we're going to use the DCF method. So it says, let's see, we can issue stock to the public for $30 a share. That's the price. The expected dividend, D1, is $3, and we believe it will grow at 5% a year. So RS is $3 in dividend over $30 stock price, and then 5% growth. So 10% and 5%, we get a 15% cost of reinvesting profit. That's not what they're asking me for, but it's worth doing that first, just to see, okay? Now let's do what they're really asking for. New common stock. All right, so same formula, dividends the same, growth rate's the same. It's gonna be my stock price, it's gonna be different. So the stock price is still 30 that investors pay, but it says flotation cost is 10%. So the investment bank's gonna take out 10%. That means we're gonna have a $3 dividend. But while investors pay 30, the company's gonna receive 27 bucks a share. So that's gonna give us $16.11%. And if you needed to do a float, compute the float adjustment, then that is simply the cost of new stock through the DCF formula minus the cost of reinvested profit through the same formula. So in this example, new stock is 1.11% more expensive than reinvested profit. And how would I use this? If I was using the average method, then I would take the average and add in that 1.11%, and I've got the cost of new stock. Okay, let's look at, so we've gone through all the, let's go back up to our formula real quick. We've gone through all the R's. We've gone through the cost of debt after tax. We've gone through the cost of preferred stock and the cost of equity, both reinvested profit and new stock. By the way, we can see here, if a company has, if a company is making a lot of money and they've got more than enough profit to reinvest to cover their needs, that's what you're going to use up here. But what if they have to grow really fast and need to issue new stock? You're going to use the higher cost of external equity, and that's going to raise your cost of capital. We'll see that in just a little bit. All right, so we'll see what happens when you have to switch from reinvested profit. You run out of it and you have to issue new stock. Let's look real quick though at the W's up here. So these are our capital structure weights. The percent of our financing, our funding that comes from debt, the percent comes from preferred stock, and the percent that comes from common equity. So let's look at those things. All right, so we've got a couple possibilities of what we could do here. One possibility would be what I've got at the very bottom, is we could look at the balance sheet and do what I've showed you guys how to do. Look at the right-hand side of the balance sheet and classify our liabilities as being operating or debt. Then we have our equity. Maybe we've got some preferred stock. And we could use those balances and figure out the percent of all that financing that's debt, the percent that's equity, and the percent that's preferred stock. We could do that. But I've got up there, don't do that. That's called book value weights, right? So book value weighting. Why wouldn't you do that? Well, let's look at the other method first. We could go and take, in fact, let's see, I've got a problem here. Let me do this real quick. Let's say we've got the following. So on our balance sheet, we've got 10 million of debt on our balance sheet, okay? Let's leave preferred stock out. Let's say we don't have any preferred stock. Let's just make life easy right now. And then we've got common equity on the balance sheet. So this is your total shareholder equity, right? Could be worded a number of ways, but it's the equity in the balance sheet. Let's say that you've got 90 million. So you've got $100 million of total net operating capital. Right, so the numbers you guys were putting together weeks ago. If you did weights on this, you'd have 10 over 100, 10%, and you'd have 90 over 100, 90% or 0.9. Those would be your weights, right? Those would be book value weights, fairly simple. On the other hand, let's say that you had market. So let's say that our debt right here, let's see, what's been happening the past year? Interest rates have gone up, right? What would have happened to, let's say we've got a bunch of debt, it's all bonds, right? We've got bonds outstanding. What would have happened to our bonds if interest rates have gone up? What happens to bond prices? Rates go up, bond prices go down. They move opposite each other, right? They always move opposite. So the past year, a lot of companies, if they've had bonds outstanding, rates have gone up, those bonds have a lower market value than they used to. Let's just say that the market value of those bonds is $80 million, right, and not 100. And let's say that, you know, this is reinvested profit, and it's also common stock, right? That's on the balance sheet. That's back when they IPO'd their stock, when they issued their stock. That AT&T's been around over 100 years. Their initial stock offering was, you know, well over 100 years ago. I suspect it was a lot lower price than they're trading at today. In other words, that price has nothing to do with their value today. Let's say that the company's stock is worth 220 million right now. In other words, not their retained earnings or their balance sheet equity, but the value of their outstanding stock. Stock price times number of shares, okay? So this would be price times number of shares. So now we've got 300 million. That's still our total capital, but it's the market value of our capital. So now we go and say we've got 80 over 300. What is that, about 24%? 27. And we've got 220 over 300. That has to be the remaining 83%. You say that?
73.
73, yes, thank you. That's actually a pretty big difference right there. So should I use these or these? You kind of see where you get different numbers if you use book value weights or market value weights. So why should we use market value weights instead? Let's think about the equity. Remember what I said? This will have like the reinvested profit over time. It'll also have the stock when it was initially offered, when it was initially IPO'd. And you think, you know, if a company's been doing its job, its stock price has gone up over time because they've done better and better. But the IPO price, what's recorded in the balance sheet, doesn't change. That's still the same from years and years ago. Put differently, let's think about it from a different way. Let's say that AT&T IPO'd their stock back in 1900. I'm making this up, I don't know back when they IPO'd their stock or for what amount. Let's say they IPO'd it at $5 a share. And let's say that AT&T right now in the market has a price of 120 a share. If AT&T went and sold new stock right now, would they get $5 a share or 120 a share? They get 120, right? It sounds like the market values are more appropriate than the book values, because remember, the cost of capital isn't the cost of your old funding, it's what you would pay for new funding going forward. So when we issue new stock, it'll be at market prices, not old book values. What about our debt? It's the same thing, right? It's the same thing there. So it's like we don't look at the rate we paid on the old bonds we have outstanding. We want to see what the rate would be on new bonds we issued today. We also have to look at what the value of of our debt is at today's prices. So, basic idea is we use market weights. Now, we've got a couple ways of doing this. Some companies actually specify what kind of target capital structure they try to maintain. Like they may say, we try to maintain a mix of 30% debt and 70% common equity. Okay, they're telling me. I'm gonna use that when I'm computing their cost of capital. You say, why wouldn't you use the 2773? Because what happens with market weights, there is a problem. You've got the stock prices fluctuate. And like they have this past week, they fluctuate a lot, right? So that means your weights could fluctuate a lot. Presumably they can fluctuate around your target. So the target's kind of this long run average that you have. So if I know a company's target weights, I want to use those, because that's how they're telling me they're going to fund future projects, right, by that mix. If I don't know those targets, I'm going to estimate them using their market weights to see what that is. I don't want to use book weights because that's not reflective of what I'd get, say, issuing stock today or issuing bonds today. That shows the same thing right there, okay? We've got, so if I want to get market weights, we've got 20,000 bonds issued at par, but they traded a premium of $12.50 each instead of a discount. So we got 25 million of bonds. We've got 2 million shares at 75 or $7.50 a share. That's 75 million. So these are market values, and you see I get 25.75. Those are my weights right there. So the weighting part's fairly simple for these. Okay, let's look real quick at some estimation issues. So we're getting out of the mechanics, we're getting kind of into the theory part real quick. Like, what are some of things that you guys, as if you become financial analysts, would have to be aware of if you had to estimate the cost of capital for a company, right? Let's look at the DCF model real quick. Let me put this model back up here. So DCF, remember, cost is D0 increased by our growth rate over P0 plus our growth rate. And I'm going to put a little squiggly over things that we're not certain about. So let's see, D0, that's the current dividend. I can look that up, right? For any company, I can go find out what their current dividend is right now. So that's a certainty. I can look at their stock price right now. I know that. That's a certainty. I don't know the growth rate because this is a future number. This is how much I think they'll grow in the future. So the growth rate in the DCF formula is a matter of contention. Different analysts could come up with different growth rates. Put differently, if I told each of you for a project in here, I want you to go home this weekend and use the same company, say Apple or Tesla, and I want you to use a DCF method to get their cost of equity. You'd go find their current dividend. You should have the same number. You'd find their current stock price. You should have the same number. Might say use the Friday closing price, right? So you make sure you got it at the same time. But you'd probably come up with different growth rate estimates. And as a result, you'd get different costs of equity. If you had a really high growth rate, you'd have a high cost. A low growth rate, a low cost of equity, right? So that's going to affect it. What are some of the methods to compute that growth rate? That's so critical in this. We can do one of several things. We can look at how have dividends grown for the company we're looking at? How have they grown historically? So for example, if we said that over the past 4 years, as an example, the dividend used to be $1 4 years ago and it's $1.50 today, that is a 10.7% growth rate. So we could look at that. We could say historically what's the rate of growth in dividends. What are you doing there? You're saying that dividends are expected to continue growing at the same rate, right? So that's one possibility. A better one though may be to use the sustainable growth rate formula that we talked about in that first part of the course, right? So the growth rate you can achieve without having to issue stock or do other things. So we get the ROE for the company, find out how much of their profit they're reinvesting, their reinvestment rate. So if they're reinvesting 35% and their ROE is 15, the growth rate's 9.8%. That's a very common way to get the growth rate in the DCF formula, is use the sustainable growth formula. The third method sounds like a cop-out, but it's actually a really good method. We'll think why in a minute. Steal someone else's numbers, all right? So get other analysts' numbers. I'll come back to this in a minute. Or what we're using for growth rates, like for mature companies, we say if you're a mature company, you should not be growing faster than the overall economy. Remember that? There. Or maybe the industry itself, right? So you're using some kind of macro data to determine your growth rate. Those are all acceptable. Why is this third one okay? You guys have graduated, become professional financial analysts. I'm gonna go and look up what you said your growth rate estimate is in some company. I'm gonna use your number, right? Why is that okay? Well, for one, I want to know that, you've got an opinion on the stock. So if I put your opinion into that formula, I want to see what kind of rate of return pops out, right? Is it high or low? I could take maybe not an analyst view, but what's called the consensus, which is all analysts who publish their views, you can average those numbers, right? And if you average those numbers, that's the consensus analyst view. But you could say that's a market determined, or basically the market's view on what the growth rate's going to be. So if I want to go and utilize the market's view, I want the analyst forecast out there. If I do the other methods, I'm using my view, right? So I could have a couple different costs of equity in DCF, depending on how I decide to do the growth rate. Different growth rates will give me different costs of equity. So there's that one. Let's look at CAPM real quick. So CAPM, risk-free rate, beta for the company, times market risk premium. That one's an estimate right there. So it's uncertainty there, which means there may be multiple ways. When you see uncertainty, it means there may be multiple ways to get that number. Beta is uncertain. There may be multiple ways to get that. The risk-free rate, we saw that early problem, the 3-month T-bill, the 10-year treasury bond. I've got multiple, they're all risk-free, but maybe one of them is better conceptually than another, right? So I've got choices here, in other words. You could say the squiggly is uncertainty, or there are different choices about how you might approach this problem. So let's look at the risk-free rate first. I know in that problem we did, we used a 10-year treasury bond. But let's think more why. Why would we do that? Here's a way of thinking about risk-free investments. Let's say that you are going to go do, you're running a business. You're going to do like, you just come to SFA, right? You've got some cash. You can go put that cash into building a new business, or you can put it into something completely risk-free. Now, what would the risk-free alternative be? A treasury, but like a 3-month T-bill or a 10-year treasury bond? Actually, the risk-free investment for you would be a 5-year treasury. Why? Because you have a 5-year horizon. And if you were to go put your money into say a 3-month T-bill, what happens? You get your money out after 3 months, you reinvest it for another 3 months, but what rate? You don't know. Rates will be different in the future. So there's risk there. What about the 10-year treasury bond? If you need to get your money out after 5 years, that's your investment horizon, and rates change, what if rates go up? Your treasury bond will have dropped in price. You'll get less than your $1,000 back, or whatever you paid for it. What if rates go down? You'll have gotten a lot more. Because you don't know what rates will do over the next 5 years. You don't know what price you'll get when you sell your treasury. So how do you avoid those two risks? If you get a 5-year treasury, at the end of your 5-year investment horizon, your treasury will pay off, you'll get your last interest plus your par value, your $1,000. So, and since it's risk-free, there's no default, you know exactly what you're gonna get. There's no risk involved. So, and from our, so the same thing can be said for corporations when they do investment planning. If I'm running a business and I've got an 8-year investment I'm looking at, then my risk-free investment alternative would be an 8-year treasury. Same investment horizon. If I do something where my investment horizon is 6 months, some weird kind of business, then my risk-free alternative is a 6-month T-bill, right? So it should match my investment horizon. Now, problem with that is, if you're an external analyst, you don't know what the investment horizon for most firms is. You'd have to guess. You know it's probably gonna be not 6 months, it's probably gonna be long term. So how long do you use? Well, you could find, 5, 7, 10, 20, 30-year treasuries. Should you use 30-year treasury? Some analysts do. Or the 20, some do that. But the most common is to use the 10-year treasury, right? It's simply common to use that one. It's kind of an odd way of saying like do this because it's commonly used, but it's the basic idea. You're trying to match up investment horizons. Also, the 10-year treasury is more liquid. There's a lot more trading in it. The longer terms, not as much, so you're never certain that those rates are as accurate as the 10-year rate is accurate. So we tend to use the long-term treasury bond rate because the investment horizon more closely matches that of the company itself, a long-term horizon. Let's see, so that's the risk-free rate. So we use the treasury bond yield there instead of T-bill yield. What about beta? Beta is an interesting one. So if you were to go and who has or has had Jadichi's investments course? Okay, so I don't know if you guys would have done this in there or not. I know he has you. He never says anything; just has you do math all the time, right? So there's no talking in that class. So I wouldn't have. Did he ever have you estimate betas, say in Excel in there?
Not yet.
What about the portfolio class?
Not yet.
Not yet. You probably will. So, so you would take, say, your stock returns. You've got your period. Say your period is a month. So 1, 2, 3. Let's take it out to say 60 months, 5 years. We don't have to go that far. We could go longer or shorter. Let's just say we did out to 5 years. And I've got some returns in my stock each month. Right, and I keep doing this, so it's going to be in Excel, right? And then I've got my market return. And let's say it looks like they're both moving together. It looks like my stock isn't moving quite as much as, or it's moving less in the market here, but more here. Maybe I could plot it. Here's my stock, positive and negative returns. Here's the market, positive and negative returns. So I plot these out and it looks kind of like there's the first month, there's the second month, and there's the next month. And then I have more data, so I keep plotting all the points up here. And I start to see a pattern, hopefully, in this data. Right, and so if I ran a regression, this would be my Y variable, this is my X variable in the regression, where you guys have done that. And you know that when you run a regression, it's going to look like this. Here's your error term. So your Y column, your X column, and you're going to get an estimate of B0, your intercept, and B1, your slope coefficient. That's your beta right there, and it's telling you basically what line goes to this cloud of data where it minimizes these distances right here. Those are the error terms, right? And the slope of this line, that old rise over run formula, that is your beta. So maybe this is 0.8 for my beta, that's the slope. For every 1% I go out to the right in the market, I go up 0.8% in stock return on average. On the other hand, if I had a line that looks like this, it's got a lot steeper slope, maybe it's 1.5, right? A higher beta. So all you're doing is fitting a line to this. So what does that mean? I could go and to estimate my beta, I would need to collect returns on my stock and returns on the market for some period of time and then run this regression and get that slope coefficient. And that's my beta. So what's the problem with that? Well, what am I using for the market? So a common choice is the S&P 500, but some others might use the Russell 2000 or the New York Stock Exchange Composite, right? There's a whole bunch of different choices for what's the market. If I use a different market than you do, the market returns will be different and my beta estimate will be different. Maybe instead of monthly, you do yours with weekly data, right? So you do 5 years of weekly data. Will you get the same estimate because it's the same 5-year period? Probably not. You'll probably get a different beta by changing the frequency. What if instead of 5 years of monthly data, you use 3 years or 2 years of monthly data? Different period, you probably get a different beta. So you start to see, if you estimate this different than someone else, you're going to get a different estimate of beta for your stock. When I was trying to bring stuff up earlier, getting everything set, that's one thing I wanted to show you. So here is Yahoo Finance. The estimated beta, so here's Apple, beta. Beta isn't 1.27 for Apple. Let me do that a little bit high, a little bit larger so you can see it. There. Apple's beta is at 1.27. That's Yahoo Finance's estimate of Apple's beta, right? Here's CNBC. If I look at CNBC, they're saying that their estimate of Apple's beta is 1.31, right? A little bit higher. Not hugely higher, but a little bit higher. I've seen some estimates where one source has it below 1, less risky in the market, and another has it higher than 1, riskier than the market. And you can get that because of how you're estimating this thing, right? So different estimates can give you different numbers up here. If you guys may or may not remember, I don't know if you would have had this in the principles course or not. Maybe you have a formula like this, looking at the mix of debt and equity. This is referred to, we're going to use it in here later in the course. This is something called the Hamada equation. And it basically says that if a company had no debt, they were all equity, so this is zero right here. So the bracket term becomes 1. Then this thing right here is called an unlevered beta. It says basically it's the risk of our business. But if you do have debt, the bracketed term is going to be something above 1. So if you use more and more debt, this number gets larger and larger and larger. And what happens is your basic, the beta you get from your basic business, what we call an unlevered beta, is affected by your use of debt over here, your financial leverage. And as you use more and more debt, it makes you riskier and it increases your overall beta. And that's the beta that we use right here, levered beta. So a firm's capital structure, its mix of debt and equity, can affect its beta. If you change your capital structure over time, it will affect the firm's beta. Just to show you a little bit, here's Walmart, some other issues. So this is Walmart's beta. How did I get this? I didn't go out and get Yahoo Finance over a number of years. I went and did a regression where I did a 5-year window, but I kept rolling it forward. I drop a month, pick up a new month, run it again. Keep doing that. And those are the betas we get from back when Walmart was a high growth company to nowadays where Walmart is a stodgy, slow growth, mature company. What would you think? High growth, the growth stages should be risky. Mature stages should be less risky, right? And look what's happened to their beta. As they've gone through the growth stage, the shakeout stage, and mature stage, their beta has reflected that. It's gotten lower and lower because they've gotten less risky over time. So another aspect about beta is it's not static. A company's beta, even if you didn't have these estimation issues, wouldn't be the same number forever because their risk can change over time as they move through the life cycle. Yeah.
Why did beta fall during the recession of 2007?
Remember, there's a statistical thing. It's how if the market is moving a lot, but Walmart stock, which is fairly low risk, isn't moving nearly as much. And around that time was the Great Recession, so the market was all over the place. Walmart was a fairly safe place to put your money, right? And so you think, if you're not getting much here, right? It doesn't mean that you have zero returns. It simply means that your returns aren't fluctuating much, but they're fluctuating a lot over here. What you're going to get when you plot it is a cloud that looks like this. Here's a stock, here's the market. If I try to draw a best fit line, it may just be a horizontal line that's close to zero, which basically a beta of zero doesn't mean that you're not earning a return. It simply means that there's no relationship between that stock and the overall market. And that can happen when you get periods of volatility in the market that aren't exhibited in your stock. That's the reason why a lot of investment advisors say put your money in safe consumer staple stocks like Walmart when times are supposed to be bad, because they shouldn't be nearly as volatile as the overall market. Your beta drops, right? It also shows me, wasn't something I was really originally thinking about in here, but that is a recessionary period right there, whereas some of these other periods where the market was doing pretty good. And so beta also fluctuates between recession and up markets, right? It can vary accordingly. This just shows you looking at Ford. That's interesting. I've got a couple of things here. I've got different market indices. So you see each date, I've got different values of beta depending on what I use for the market, right? That's what I was talking about over here. Look at Ford though. Their beta's gotten higher over time. Ford's a mature company now. They're a mature company in here. They're a mature company back in 1987 at the start of this timeline. So why have they gotten riskier? They've taken on a ton of debt. They're not any more profitable. They've got a lot more debt. They've increased their risk over those 30 or some odd years up there. So this is what I was saying. When you add on debt, it increases your risk, and that should be reflected in your beta getting higher. And for Ford, they did exactly that over this 30 some odd year period of time right here. They added debt into their capital structure, and their beta started to shoot up over time. As they did this, they became a riskier company. Let's see. Let's go back up to this real quick. All right, so what could you do to get beta? You could go and, I guess I have a slide for it. You could go and get the data and come up with your own estimate. You could go and use someone else's estimate with the understanding that you might want to get several estimates and average them out, right? Because they're all going to be different for obvious reasons that we've talked about. Those are usually the choices, is you use a published estimate for beta, or you simply estimate your own beta statistically via a regression of stock returns and market returns. Okay, let's see. Let's look at The next item on the list, let's look at this market risk premium over here, the last item in this. So the market risk premium is how much the market returns above the risk-free rate. It should be an expected market risk premium, how much we think the market will do in the future relative to the risk-free rate. That's the way it should be done. How is it usually or often computed? There's three common methods. One is lots of analysts look at the historical record, and they'll collect data and say for each month or each year, they'll say, what was the market return on this date? What was the risk-free rate in this date? And they'll take the difference. And they'll do that, say, maybe every month for however many years, or every year for however many years, and they'll average that difference out. So, they may take return on the market, say 10% minus the risk-free rate, and this might be, say, I'm just making numbers up here, 2022. Let's say that was 2%. So market risk premium would have been 8%. And then maybe in 21, the market did 25% return and the risk-free rate was 1%. So you get 24. And they could keep doing this and then take the average, and that's the number that gets used, the historical method. So that's one way right there. What's the problem with the historical method? Well, there's a couple. I'll show you a slide with this in a minute to show you how bad this can be. We had an issue with the risk-free rate, right? We were thinking maybe the 10-year Treasury is the best, but not all analysts use it. Some use a short-term T-bill. Some use an even longer-term Treasury. If you change the Treasury, would it change the risk premium? Absolutely, because you get different yields for different maturity Treasury. So that would change it. That would change your average that you end up using. What if I went back 10 years versus going back 50 or 100 years, a different period that I'm getting the data from? Could that change it? It absolutely could. So, here's what it looks like bring it up to 2018. So I haven't updated it in the past couple of years. But from 1928 to 2018, here is the return on the market, the risk-free rate. This was the average market risk premium over that time period. Okay, so 5.1%. If I use 1969 to 2018, the risk-free rate was a bit higher on average, the market return a little bit lower. The risk-free rate this number right here, it should have been the same. I'll have to go back and check this. That will give me a little bit different number right here as the difference in those. All right. Here is a much more current period. You can see the difference, almost zero on the risk-free rate, higher in the market return would have given me something's up with these numbers over here. That should be the difference in these series right here. So which one's right? Well, a lot of stuff that we have in here, what's right or wrong, it gets into statistical arguments. So when you do this regression down here, what do you get with that beta estimate? Right there. You get a t-stat, right? You guys remember that stuff? You get a t-statistic with it. And a t-statistic's based on your estimate and your standard error. Right, and the standard error can be made lower as you use more data. So if I have more data points, I can reduce my standard error and get a better estimate of beta. Which of those three choices up there would have had the lowest standard error if I did a statistical analysis to get this? I would 1928 to 18, 69 to 18, or 09 to 18, a longer period of time, because it's got more data in it. right? So I have a lower standard error in this thing. So I should use 1928 to 2018. Maybe not. The economy's changed, right? We went through a world war during that period of time. We went through really high inflation that was worse than this period, in that time period. Our economy's gone from a mostly manufacturing economy to a mostly services economy. Maybe that affects everything. There have been structural changes. So maybe the more recent period is more reflective of our economy. But because I have less data, my standard error is going to be higher, which means I don't have necessarily a lot of confidence in that estimate. All right, so you kind of see what I'm getting at here. More recent periods that are narrower look more like the economy today, but statistically, the numbers we get are less reliable because you don't have a number, you've got a confidence interval, right? It can be a range, and your standard error tells you how big that range is going to be. I like a small standard error, so I have a narrow range, but I only get that with a lot of data, which means more years back. But that may not be reflective of what the economy is like today. So I can do the historical or backward-looking market risk premium, but it's got those issues. I can, down to the last one real quick, I can use someone else's estimate, right? Which, again, it sounds like a cheat, but I want to see what your estimates are to see how are mine kind of in line, right? Or do mine look substantially different? I might question like what you're doing or question what I'm doing. So I want to see what you're coming up with. The middle one, I want to get a forward-looking and estimated risk premium using expected future prices. This is an approach that's getting used a bit more. Let me get this done real quick and we'll call it a day. We'll finish up the stuff on Tuesday, okay? So let me show you how we're going to do this thing right here. We're going to use the DCF model to do it. Actually, let me just erase that. So I'm going to use this right here, not to get the return on our stock, I want to get the return on the overall market. So what would I do? Let's just say the market's going to be S&P 500. So this is going to be the S&P dividend right here. This will be the S&P 500 index level. Like what's the S&P trading at right now? And then I've got my growth rate. Growth rate in what? Well, it could be dividends in the S&P 500. So not a company, but all, the average growth rate across all of them. Or I could use that macro estimate, right? Don't grow faster than the economy. So I could use US GDP growth. If I had those, I could put together an estimate of the market return and then subtract out my risk-free rate, and I've got my market risk premium, but I've got a forward-looking one. And the nice thing about this is I don't have to worry about confidence intervals or standard errors because I'm looking at historical data. I'm doing a forward estimate on this. Let's see. This one was done, did I do this? I think I updated this back in the spring. So, no, this may have been a year ago. The level of dividends at the time I did it in the S&P 500, that was the estimate of the growth rate at the time for GDP growth, 5.5%. There was the S&P 500 index level at that time. And so you put all that together, you got 6.9%. The risk-free rate at the time was 1.55, so the difference was what we call the implied equity risk premium, or the forward equity risk premium. So that's a method that gets used an awful lot to get this thing, is to figure it out using the DCF formula with the market data. All right, we've got one more set of topics we'll talk about in this chapter. We're going to hit those on Tuesday next week. We're going to look at how the cost of capital differs when you look at divisions versus the entire firm.